Let's dive into our keynote presentation this morning, Trends in Alternative Investments and Private Real Estate. Legal disclaimer, I already read a moment ago, but just once again, this is not legal advice or investment advice. Please consult with a professional before taking any investment decisions. WealthChannel, we're the two main co-founders here, Jimmy Atkinson and Andy Hagan's. Third member of our team is Michael Johnston behind the scenes. I don't know why we didn't get his face on there. Michael, maybe we'll get you up there next time. But Andy and I were the ones who kind of started WealthChannel here. It was born out of, a lot of you follow me through my Opportunity Zones platform, Opportunity DB. And the reason why we formed WealthChannel was to educate high net worth investors on how they can benefit from adding alternative investments to their portfolio. We saw a huge education gap, and we offer a lot of resources through WealthChannel this event today, Alts Expo being one of them. Today's event is focused, and really our platform in its entirety is focused on alternative investments. But what is an alternative investment exactly? It's anything that isn't a traditional investment, essentially. Traditional investments include those types of investments which are publicly traded stocks, bonds, cash and cash-like instruments. Alts, on the other hand, are basically anything that aren't those. So they're non-traditional. They are generally illiquid. There might be a long holding period or a lockup period. You can't simply, if you decide to sell, you're not going to find a buyer necessarily immediately that same day or later that day, like you would with some of those more liquid assets, stocks, bonds, and cash. There's some benefits to being illiquid, though, we'll discuss in a moment. They're also oftentimes referred to as private investments. Not all, but the vast majority of alternative investments would be considered to be private, non-publicly traded investments. Some of the benefits of alternative investments, there's Andy and I have really uncovered or discovered or think that there are three main benefits. There may be more benefits than these, but primarily these three benefits are portfolio diversification. If you're a traditional investor, you might have a stock bond portfolio of 60-40 stocks to bonds. And you've got some stocks, you've got equities and publicly held companies, you've got some bonds that are publicly traded, but you're missing a large swath of the investment universe when you limit yourself to just stocks and bonds. So this allows more portfolio diversification. There's also many tax benefits with investing in alternatives, which we'll get to in a minute. And the potential for enhanced returns, we're going to talk about the illiquidity premium and how that can offer enhanced returns in just a moment here. So to touch on portfolio diversification just for a moment, a typical brokerage account at Fidelity, TD Ameritrade, Schwab, Vanguard, wherever you may hold your investments. Maybe you work with an RIA who has you just in traditional investments. You're really just focused on stocks and bonds, mutual funds, ETFs that hold stocks and bonds, and cash-like instruments. With alternative investments, you get access to non-public asset classes, including private real estate, private equity, private credit, hedge funds, and oftentimes these are beneficial because they're non-correlated to public markets. So your portfolio overall experiences less volatility, and over time, in theory, better returns, which we'll get to in a moment here. The second benefit of alternative investments we've identified as being tax benefits. There's a ton of different tax incentives and tax advantages that go along with being an alternative investor. So some of these are tax benefits that are inherent to certain asset classes. If you're an energy investor in any oil and gas deals, you're probably well aware of some of the that asset class's specific tax provisions, including intangible drilling costs and depletion allowance. Those are very specific tax benefits that are specific to that asset class in particular. If you're a real estate investor, you're probably very familiar with depreciation, accelerated depreciation, bonus depreciation for the last couple of years, and ongoing through 2026. That's just one type of inherent tax benefit with regard to real estate. I don't have time to drill into exactly what those terms mean. Today, we only have a few more minutes before our first fund presentation, but those are a couple examples of some of the tax benefits that are inherent to certain asset classes within the alternatives universe. There's also tax credit programs that can get layered onto investing in alternatives. Tax credit programs like the historic tax credit, HTC here on the slide deck, renewable energy tax credits. The Inflation Reduction Act that President Biden signed into law last year allows for a renewal of a lot of these renewable energy tax credits that can really spike the returns for investors on a lot of these privately held real estate and infrastructure and energy type of alternative asset deals. And those are just a few examples again. And then thirdly, there's tax wrappers that wrap around an asset, particularly with regards to real estate now, these three. The Delaware Statutory Trust or the 1031 exchange allows ongoing deferral of capital gains tax. REITs have built-in tax advantages, including no corporate tax and pass-through depreciation to its investors, and QBI deductions on the dividends as well. And then opportunity zones. A lot of you may be familiar with that because that's kind of how I got my start in this industry, and a lot of you have been following me for a while. Allow essentially for deferral of capital gains tax and an eventual elimination of capital gains tax liability after a 10-year holding period. So some great tax benefits there. And then finally, we talked now about diversification. We talked about tax benefits. Let's talk about enhanced returns. And there's two ways to really consider enhanced returns. We've got a picture of Meb Faber's The Ivy portfolio, which has been a big influence on myself, but especially on my partner, Andy Hagens. Within an asset class, you can look at enhanced returns in terms of the illiquidity premium, which was made famous by David Swenson and his work with the Yale Endowment Fund. And the theory is investors get better returns in exchange for sacrificing some liquidity. You have to compensate the investor more with higher returns and a higher RRR. Now, within an overall portfolio, oftentimes you can think about enhanced returns in terms of less portfolio volatility, which can lead to higher risk-adjusted returns in the long run. And I've got a chart here, courtesy of McKinsey Investments, which kind of shows this theory a little bit. The power of private assets, they've titled this slide, and this is comparing a traditional portfolio, which it doesn't state on this slide anywhere, but it is a 60-40 portfolio, and how it compares over time, the performance, how it compares over time with a portfolio that allocates 20% to private investments. So instead of a 60-40, you've moved into a 50-30-20. You can see you end up getting an excess return of about 1.2% over the long run. Let's talk about what some of the major alternative investment asset classes are. So we've identified these 6. There may be a few more that we're missing here. We kind of haven't included collectibles or crypto or some other weird type of niche alternative asset classes. But these are like the 6 main ones: private real estate, private equity, private credit, hedge funds, infrastructure and natural resources we lump together. And then liquid alts is a 6th one. These are alternative investment strategies that are actually available on the public markets through hedge fund replication ETFs or energy ETFs or commodity ETFs. Private equity, let's go through that real quick. There's 3 different types of private equity: a leveraged buyout, growth, and venture capital. Twitter being a great example of a leveraged buyout when Elon Musk came in, bought the thing, took it private, fired most of the staff, and he's trying to grow it back to being highly profitable. Private credit is contrasted from publicly held debt, corporate bonds or treasury bonds and T-bills. Oftentimes a little bit higher risk, but the reward for investors is they are typically higher yielding. And those are the 4 different types of private credit that you can find: typically direct lending, asset-backed, subordinated debt, and then distressed or special situations debt. And this chart shows basically how private credit here stacks up against investment grade bonds and high yield bonds that are publicly traded. These yellow ones here, this green shade here has a much higher range of IRR. And you can see the different types of private credit strategies under there. And then private equity, even a little bit more of a boost above private credit. Again, higher risk, but higher return. Hedge funds is another type of alternative investment asset class. I don't have time to go through this in detail, but did just want to point out, I've got a picture of a hedge here. So just kind of a dad joke that you guys would appreciate. And then the final asset class we're going to touch on before we move to the 800-pound gorilla in the room, which is real estate, is infrastructure and natural resources, which includes stuff like energy, agriculture, timber, power, etc. And we do have a energy fund presenting later this morning. Private real estate is the biggest asset class within alternatives. It's the most popular. It can be thought of in terms of its sectors and in terms of its strategies. The major sectors, and there are many more, by the way, than these four, and there are different subtypes within each of these sectors, which I don't need to touch on for today's purposes, but multifamily, office, industrial, retail are the four major sectors, and then the major strategies moving from lowest risk, lowest return to highest risk, higher return is core, core plus, value add, and then you have opportunistic or development strategies as well. There's many different tax advantages with regards to real estate investments. These are some of the different wrappers. I've already discussed them earlier, but Section 1031s, DSTs, opportunity zones, private and non-traded REITs each have their own tax advantages that are accessible if you're a real estate investor. Let's talk about some trends, though. The trends and the opportunity for high net worth investors to capitalize on these trends. Essentially, we're seeing tremendous growth in this industry over time, growth of the overall alternatives investment market through these three main channels: institutional, broker-dealers, and then what most of us are doing here today, which is direct retail, high net worth individual investors investing in alternatives, which really wasn't possible until recently. You can see how the industry has grown tremendously since 2010, 2012-ish. It has nearly tripled the amount of assets under management in alternatives over the last 10 plus years. And it's being democratized as well. Access to alternatives has never been as great now as it is greater now than it ever has been. And we really have the Jobs Act of 2012 signed into law by President Obama to thank for this. It's when the SEC lifted its ban on general solicitation for offerings conducted under Rule 506C. Essentially, this event today would not have been possible but for that action to move to deregulate access and deregulate the industry a little bit. Despite this, by the way, if you go back to this previous slide, we have over $12 trillion in assets under management in private investments. Only $1 trillion of that is held by retail investors. And there's a huge opportunity here for retail investors to improve their allocation. According to McKinsey, retail investors currently have only 2% of their assets held in alternatives. That's as of 2020. Institutional investors, on the other hand, by the way, who have had access to alternatives for forever, right? The alternatives have traditionally been the playbox of institutional investors and the ultra wealthy. We're talking university endowment funds. We're talking CalPERS, other huge pension funds. Those have really been the only investors in alternatives up until about 10 years ago. We're suddenly starting to get, over the last decade, this rush into alternatives from the high net worth individual investor, the Main Street investor. Institutionals have 30 to 50% of their allocation in alts, and the retail allocation is expected to grow tremendously from 2% to 5% just in the next 2 to 3 years. And then beyond that, it could hit 10% and more over the course of the next decade. So something for everybody to consider today is this is an ongoing trend that you're taking advantage of by being involved in today's event. Here's some recommended resources that we use to solve the education gap, because there is this gap in education. I would also plug WealthChannel and our 3 major podcasts. Andy Hagens hosts the Alternative Investment Podcast. My other colleague, Michael Johnston, hosts the Tax Efficient Investor Podcast. You'll be hearing from him on the panel later today. And then I host the Opportunity Zones Podcast. All of these are designed to increase investor education and awareness of alternative investments.